Hi everyone, it's Claire from Piece Together Money Coaching, and I'm here in the office today. It's a Tuesday and I'm here with Meg. This is Meg.
Hi everyone.
Who is a tax advisor from Dynamix Accounting, who is here to answer any questions that you guys have got about tax, what you need to be doing, not doing. Hi Sabrina. Put any questions that you've got in the comments box and we'll stop periodically and go through and answer those. But in the meantime, I'm just going to get Meg to give you a couple of sort of tax tips, things that are useful for people to know, and we'll go from there.
Okay, lovely. Thank you very much. Thank you very much for having me today. I just wanted to talk about, there's a lot of people that have their own and managed business, and they often ask me, what can I take out of my company before I have to pay tax? And so we're in the new tax year now, so we're in 1920 tax year. So I thought I'd just run through the rates or the strategy that you might want to have a chat with your own accountant with to maximise the money you take out at the best effective rate of tax. So we would always suggest a combination of salary and dividends. So you take a small salary and then top up with dividends. So for 1920, the amount of salary that you'd be looking to take is £8,632. So we're looking at £719 a month. Now that doesn't seem very much, and you might go, "Oh, why are you setting it so low?" That entitles you to a national insurance year, which is always quite useful should you need to claim anything later on. And then the dividend rate above that is 2,000 is tax-free, and then the rest is at 7.5% up to 50,000. So where you're taking out £50,000 from your company, you'd be looking at taking 8,632 as your salary, and then the 41,000 top up as dividends. And if you take that in that strategy, as I've just described, you'd actually be paying tax of only £2,663 for the year, which I worked out this morning was a 5.3% rate of tax, which people normally go for your 20%, your 40% rate of tax. If you're doing that strategy, then you're looking at 5.3% of tax. So I think just an easy way of setting up the structure of your income coming in for the year can make a big difference. If you were to take that 50,000 as salary, you'd be paying an awful lot more tax and national insurance for yourself and for the company. So that's always a really good starting point when you're looking at your company accounts.
Because they've changed, haven't they, how they treat dividends and that type of thing. And at one point you could take out loads and loads of dividends and didn't really pay any extra tax because the tax had already been paid on them.
Yes.
And then you had your dividend allowance of £5,000 and then they put that down, didn't they?
Yes. So the 5,000 that they started with has now been reduced down to 2,000. So that's an allowance to, I mean, it's generally to cover people that have generally small shares, but it's also a useful possibility for if you've got your own company, so you can take that £2,000 without any tax effects at all. So you could take, if you took 10,000, the first 2,000 would be exempt, and then the remaining 8,000 would be at 7.5%, or if you were over 50,000, 32.5%. But we're still looking at 7.5% and 32.5% versus your 20% and your 40%. So it's for people who have got the directorship and their shares in their own company, that's definitely the way to go.
And what about for people who own their business, say it's a husband and wife and they're both directors in the business? It might be that one has a more active role than the other. Can they both take the dividends out like this?
Yep, you can set it up however you like. You could both have the same number of shares set up in the business. Or alternatively, you could set up shares that have different rights. So you would have maybe an A share and a B share. So husband would have A shares and wife would have B shares. And at which point you could vary the amount of dividends you could take. So you could give the one that was more involved in the company more. Say, for example, say the wife was the main person in the company, the husband helped out but also had another job that was his main job. You might want to give them less dividends because they're already using up allowances.
And they're already paying a lot of tax.
Yeah. So you don't want to have to equalise the dividends by having ordinary A shares and ordinary B shares. Then you can vary it between
Cool.
how it works.
And what about if you're a sole trader? So you run your business, there might just be you, and you haven't thought about being a limited company. What do you do with taking your money out of the company then? Can you spend all of the money in your business, or should you keep some back for things?
What I normally say is, for tax purposes, you always want to provide as you're going along for your tax. You don't want that big surprise at the end of the tax year when your tax advisor or accountant does your tax return for the year. So I would generally put aside about 25% of your income. If you're working out your income less your taxes, so you've got a sort of a cash flow going on, then you would be taking 25% of your profits as a sort of a standalone figure. I worked out for another client recently that on £50,000 as a sole trader, you'd be paying about £12,000 of income tax and national insurance for 1920. And as I said, 25%, that worked out as 24% of tax. So you don't have that advantage of being able to claim the dividends at the lower rate. It's all taxable as earnings, and you are looking at the 20% and the 40% where it goes over the £50,000 for the year. And you can't, what you take out of the business isn't necessarily what you're taxed on. You're taxed on your profits. Whereas if you were a company director, you would take out what you needed and perhaps leave the remainder in the company to sort of push it forward, to grow it.
So on an income of £50,000, the difference between being a limited company and taking salary and dividends against taking it as sole trader profit can be phenomenal. I mean, that's Absolutely. An extra 10 grand a year of tax.
Yeah, so you're comparing 12,000 with 2,600. It's a massive saving because you don't have the national insurance charge that you have on your sole trades. So your national insurance for class 2 and class 4, which is chargeable on sole trade profits or partnership profits, is charged at 9% over and above a small threshold. But with companies, there's no national insurance on dividends. So you're making that initial saving, and then you're comparing a 20% rate of tax on profits versus 7.5% on dividends. So there is an enormous saving. So if you're considering that maybe you want to go into a limited company, it can make, sort of, like I say, £10,000 of saving just in that first year.
Wow. And in your first year, when you start setting up your business, I mean, if you decide that you're going to be a sole trader, you can change to being a limited company later, can't you?
Absolutely. You can start up as a sole trader. You can then introduce a partner, perhaps, and then you incorporate into the limited company. So you would form the company at Companies House, and then you would register with HMRC that you have this new entity, this company, that now runs the business and has the trade, and then the trade and the assets would go into the limited company, into their balance sheet, rather than being your responsibility as a sole trade. And forming a company is not actually too tricky. It's a matter of going into Companies House and setting up who the shareholders are, who the company directors are, and you might want to appoint a company secretary or something like that. But it's not an arduous task, and it's not necessarily for people who earn hundreds of thousands of pounds. It can make a big difference, even at the smaller amounts.
But if it's something that you don't feel comfortable doing, then accountants and people like that will help you set it up?
Oh, absolutely. We form companies quite often for sole traders or partnerships. Sometimes people go straight into the company, sometimes they have to sole trade first. Yes, so we're, as at Dynamix, we do form companies on behalf of individuals if they need that help, but it can be done yourself or by an advisor.
And in terms of people being self-employed, I mean, one of the things that people like about being self-employed is they can claim things as business expenses if they're things that they are doing genuinely for their business. You can't just buy everything you want and say the company's paying for it. What are the most common things that people should claim for and often don't realise that they do, or things like that?
Often people don't think about their use of their mobile phone because they had their mobile phone before they started their business. If you're using one phone for personal use and for private use, so personal use and business use, then you can take a proportion of your phone bills for business. Equally, if you're using your home as your office, there are simplified expenses that you can claim for use of home as office that can be quite useful. If you're using a significant amount of your home, you would take it as a percentage of your home One thing I would be careful about is saying that it was wholly for business, because then it can interfere with capital gains tax exemption that you might have on your own home. So just be wary of that. That if we're saying that it's wholly the business side, but then it might affect your capital gains tax as a person. So phones. Some people don't think about use of car. I always suggest people keep a mileage log if they're going out to clients quite often, and then you can claim it as a flat rate as an allowance. So it's 45p a mile for the first 10,000 miles, and then 25p thereafter. So it might not sound very much, 45p a mile, but actually when you rack up a lot of miles, that can quickly come into sort of thousands of pounds that you can take off your profit and save yourself extra tax on that. So you want to maximise your expenses to minimise your tax, really.
I find with the mileage, personally, it almost feels a bit like free money, because I claim 45p a mile for my travelling, and I put in when I go and see a client like I have today, or I go to a networking meeting, or I have to go down to the shop and buy paper when I run out to the printer on the days that I forget to get it ordered and things like that. And one thing that I found is, because I pay for my petrol out of my personal account, I don't sort of really notice it. I just see it as a household expense. And at the end of the year, when I add it up and realise that effectively my company owes me a couple of £1,000s worth of petrol money, it's sort of money I wasn't expecting to get back, if you see what I mean.
It feels like a bonus, doesn't it?
Yeah, it's a bit like free money, and we all like free money. Free money is great, which is
absolutely,
which is one of the reasons we go.
The other thing that people often don't know about, there's a new allowance that's come into play. Came into last year for 18-19. It's called the trading allowance. It's a £1,000 trading allowance. If you've got very small expenses, say you're just starting up as a sole trade, and you've got very small expenses, you can claim this trading allowance of £1,000 without having to keep any receipts at all. So that can be quite a useful one if you've got small expenses. You claim that £1,000 as an allowance, a straight 1,000, and then obviously that can save you your income tax at 20% on that £1,000. So it's a £200 saving straight there, and it's an allowance that's available to you, available to all trades.
So if you're just starting out your business and you know that you're not going to earn very much this year, do you still have to register as self-employed?
Unfortunately, yes, you do. I have had clients before where they're a couple of years out of date because they're of the idea that perhaps they're below their personal tax-free allowance. So they might say, oh, well, I didn't earn more than £10,000. I don't need to do a tax return. Well, actually, you do. You need to register, one, for the national insurance contributions that you might need to pay, because the national insurance thresholds are slightly smaller. And also, if you're a startup business, you might actually be in a loss-making situation. If you don't register and declare that loss, then you can't use that loss against a future year. So you don't want to sort of waste those expenses that you had in the first year. It might be that maybe you're starting up and your income's not actually coming in yet. You're still trying to build up that business. So you've got lots of sort of what you might call pre-trading expenses. And you want to maximise those. You don't want to lose those. So we need to register with HMRC. And if you've started since April last year, so April 18, then you can register online now. It's a straightforward, bit like Companies House, a straightforward registration which you can do yourself, but equally an advisor can help you with that.
So you guys, it's great we've got so many people on. Anybody got any questions besides that, things they want to ask? If you can get it in the comments box now, we've got a chance to answer them live. Put it in the box, it's here somewhere. Other than that, people who are watching on replay, if you've got any questions, you can put them in the thread and I can speak to Meg later and we can answer any other questions you've got. I mean, tax is something that I've covered as a financial advisor in various cases because there are things that we can do to help you as well. And the basics of which I know, and I know the stuff that affects you in the day-to-day. But the key thing about the job that I do is that I have got a pool of people that I can call upon, like Meg, where I can ping her an email and say, I've got this question and get an answer, and likewise that she can do the same with some of the finance technical stuff as well. So there are always people out there you can ask, and we've covered this before. You need people in your power team that can help you, people who have got the skills that you haven't. And like, you know, Sally in my office, who's got the neat handwriting and is allowed to write on the board behind me here, which you can't see, luckily is out of focus because I'm not allowed to write on the board. My writing is appalling. You know, you want people in your team that can help you. Any other questions? Anything that anybody is dying to do before we say bye and we're finished? No, I think we're there. People are a little bit shy. So we are looking to do more live videos like this. If there are other experts you'd like me to get in, please let me know. We'll do a short live with them and answer any questions you've got. If you think of any questions later you want to ask, either put them in the group. If you're too embarrassed, private message me and I can do it as an anonymous post. But you can bet if you've got a question about it, somebody else has. So thanks very much for watching, everybody, and we will catch up with you again later in the week. See you later.
See you later.
Bye.
Bye.